Prescient Investment Management is a quantitative investment management house with a total BEE shareholding of 29%. The Prescient Balanced Global Fund was founded in 2004 and is targeted at investors with a medium to long-term investment horizon. Liang, portfolio manager at Prescient Investment Management, joins us now from our Cape Town studio.
Liang, can I just ask you, in terms of your balanced fund, your global balanced fund, how are you positioned for the current environment, given particularly all the uncertainty? Are you seeing it as a time period to be fairly conservative, or do you think there are some investment opportunities that are not being effectively exploited at the moment?
Kevin, I think from my perspective, there's one thing that we're really seeing that came about almost last month. If you look at our equity markets, we're trading at around a P of 12 to 12.5. And that usually shows that that's an average valuation. It's not a very expensive valuation, but it's not a super cheap valuation. Resources in our economy are trading at a P of about 9, and that's really pricing in a very, very, very bad outcome. Now, given the huge risk in Europe, normally I would say stay conservative. However, what you saw last month, actually in the month of March, is that given all the uncertainty, somehow protecting equities became super cheap. It in fact was the cheapest period to protect equities over the past 5 years. So how we position in our portfolio is that you might as well know cash is 5.5 yield, very, very low yield. You're not going to beat inflation by sitting in cash. I think Arno covered bonds very well. You're at best neutral. You're not really getting a lot of risk premium on that. But equities, which can deliver you a lot of upside, has a lot of risk. So what we've decided to do is to buy a lot of equities, but protect that. So the way I'm positioned is that I'm sitting at around 65, 70 equities. However, I have a derivative protection in there that will protect me from a fall for the first 20% of the market. On top of that, we're also protected by having an offshore exposure. And on top of that, we have a little bit of gold in the portfolio to kind of protect the portfolio from really, really bad outcomes.
Liang, let's break down your equity basket in terms of where you are positioned at the moment.
Absolutely, Bronwyn. I think in our model, how we look at it is that you want, so we look at fundamental factors, things such as dividends, profits, book values, as well as our cash flows. At the same time, we want to look for cheap stocks that are moving and has momentum. So if you break down the sectors, what you see is that financials fits that perfectly. They're relatively cheap compared to other stocks, but at the same time, they have momentum. So we overweight financials. Moving on to resources, what you see is that they're very, very cheap. So by being underweight resources, it's quite dangerous. You can have massive rebounds off the low base. And what we are is we're pretty neutral resources, except for the platinum stocks, which continue to show no earnings and no momentum. And finally, we get to our really, really expensive consumer retailers, consumer services, and consumer goods sectors, and we underweight those sectors.
Liang, can you just go back to the hedge that you've put in place, or the protection that you've put in place on the equity portfolio? You said earlier on that the cost of protection is relatively cheap. Can you explain why that is, given the uncertainty? Somebody looking at the show.
That's an amazing thing. Yeah, I think that's what we found, that we were very surprised by it. But in March, I think for a very brief moment, the world thinks everything was fine. And people thought Europe was going to be okay, everything was going to be fine. And you saw the price of protection come really cheap in both America as well as South Africa. And I think we took that opportunity and said, well, thank you very much, we'll lock that in.
You don't see any safe haven status in gold. I see it's missing from your asset allocation here. Have you stayed away from gold for a long period of time? Has it ever been of any interest?
Oh, actually, our asset allocation does show it, because we have a few gold companies in the portfolio, and that's including the equity portion. But we had gold in our portfolio since about September 2010. I do keep it in there. It's a small part. Let me go take one step back and say what we try to achieve with the portfolio is to deliver long-term real returns, right? So we want a mix of assets that's, the sum of, the total is better than the sum of its parts. And I think gold has a role in that. And about 7% of our portfolio is in gold.
Liang, how much interest is there in offshore investing from your perspective? Obviously, you say your portfolio, look, I like what you said, that your portfolio is protected by having offshore. Obviously, some people may disagree with that. But how much interest is there from your perspective, from local investors in investing offshore?
Okay, let me explain that. We're actually quite different from other people. So when we say we invest offshore, we invest in protected equities offshore, right? So our philosophy is that if you take money offshore, so what you're trying to benefit from is when things go really bad, the rand blows out, as we've seen recently. But if you invested in equities offshore and you're not protected, if the rand blows out and the equity falls, you're not really doing much for your portfolio. So when we took our money offshore, we definitely did our positive return offshore fund. And what it does is that it's fully protected offshore, and that has worked very well for us. I think in terms of risk appetite of, let's say, taking on risk in Europe or something, although valuations are very, very cheap and we're keeping on watch, I think the government policies that just does not interest us at the moment.
How do you feel about the world right now? We were obviously pushing Arno a little earlier in the discussion. We've also got Iraj's stance on the world. And obviously this is all about capital protection. So it's going to work in your favor if things are a little bit turbulent out there, well, we hope. Are you very concerned about the state of the world?
I think you can't be too bearish because everyone is so bearish already. I think we're almost like at the knife's edge where it can go one of two ways. One way is that Europe can come together and come up with a real solution. If that's the case, then equities are very, very cheap. It's going to deliver you real returns. This other way, which is a very, very scary way, is that Europe actually breaks apart. I think currently we're more heading towards that road rather than Europe coming together. But we'll have to see.
Liang, in terms of your bond exposure or anything to do with your fixed interest exposure, do you have place in the portfolio for inflation-linked bonds as another means of protection?
That was going to be my next question. You stole it from me. So I'm also asking you about inflation-linked bonds. Let me throw in my hat into the ring.
We have some inflation-linked bonds in the portfolio that was added at very attractive rates. And I think that's a key thing, right? So if you look at inflation-linked bonds around the world, they are in fact very, very expensive. So what you really have to do is to go out there and look for inflation-linked bonds that still provide real yields and not lock yourself into long-dated inflation-linked bonds that are delivering you negative real yields, as what you're seeing in the US.
Liang, if you, let's just stand back a little bit, because as I go through each asset class in your portfolio, you really have built up this portfolio for protection, which I understand. Yet at the same time, you're saying that some of these asset classes are relatively cheap. I mean, you mentioned banks, you mentioned the resource sector. How are you marrying the two? Why don't you simply have a longer term view and saying, I'm buying assets that are relatively cheap and I'm simply going to hold these assets for the longer term and then forego all the cost of protection?
Kevin, I think to answer that, you have to be very, the economy is very cyclical in nature, right? So when you have things like austerity measures, people lose income. With less income, people are less confident. With people are less confident, people spend less. When people spend less, the government gets less taxation, and you have a bigger deficit once again. So I think the danger of being just long and saying the longer term is that the longer term never comes. And as you well know, Italy is the third biggest bond market in the world. If that actually blows up, I think all bets are off. So to really say, well, I'm investing for the long term, you have to be really, really brave to do so. And I think when we bought the balance fund, we kind of said, well, if I'm an investor, what do I really want? So the first thing I want is I want to have a mix of assets that deliver me long-term real returns. The second thing I want to be diversified and uncorrelated, so I have these steady returns. And the third thing I really want is not to lose a lot of money because you work very hard to save. The last thing you want to do is have all the savings and lose 40% in a year because Europe blew up.
What's happening with dollar rand? Same question I put to Arno a little earlier. Dollar rand, he thinks capital flows are going to continue to come in strong into South Africa, a stronger level on dollar rand. We're at 845 right now. Your stance?
Our stance, we were full offshore when the rand was about 730, and we cut it down to half offshore, so we'll have 10% offshore, with the rand currently at about 840 at the moment. And the reason we did that is that on a longer dated basis, if you look at some sort of PPP valuation model, you see that we're starting to head toward neutral territory rather than being extremely overvalued. Having said that, if Europe blows up, all bets are off.